Hello, good evening. Thank you all so much for making time in your busy schedules to join me, Kevin Cumbus, and my colleague, Ryan Mingus, for TUSK Partners 2022 M&A overview, kind of a look back over the last 12 months, and our 2023 M&A outlook. Where are we going? If you spend any time reading the paper these days, you see that the cost of capital is going up. Still a lot of rumblings about a little R or big R recession. Wage inflation is here, and it's typically here to stay. It's a pretty sticky number. So how is all this going to impact valuations in the dental market going forward? We have an action-packed evening planned for you all, and we look forward to digging in. Just a little bit of housekeeping before we get started. Please remember to log any questions you have in the chat box, and we will certainly get back to you within 24 hours if we don't get to your questions this evening. One other housekeeping note, if you see anything you have a question about that you want to learn more about, feel free to reach out to either me or Ryan Mingus directly. More than happy to spend more time with you all on these slides, these concepts, these ideas. Again, our primary objective for all of our clients, anybody who's on this webinar tonight or listens to any of our stuff or reads any of our content, is that you leave more informed than when you joined us. So feel free to reach out directly if you have any questions. And without that, we will go ahead and get started. Means of introductions. My name is Kevin Cumbus, president and founder of TUSK Partners. For those of you who don't know me, hello, nice to meet you. And my career, just very briefly, was about 10 years of finance and investment banking before 15 years in the, I would call it the dental economy. Worked as a broker, worked inside of a large top 5 DSO in business development and operations, built a dental practice and sold it. So I probably survived that business more than anything, and founded TUSK in 2016. So I am joined today by my friend and colleague, Ryan Mingus, Managing Director of the M&A business. Ryan, welcome.
Thanks, Kevin. First of all, really excited about this opportunity. Last year was really great in doing this webinar. I had an opportunity to reflect on a very, very, very hectic 21 Q4. This year, certainly had a pretty busy Q4, and now an opportunity to reflect in preparing for this webinar has been just really great. Looking back on the team that we've grown, we'll review here in a second. But this webinar is always really exciting for me because it's an opportunity to reflect on the year that was, and sitting 19 days into the new year, about the year that will be. So thanks, and thank you all for attending. Ryan Mingus, Managing Director of M&A here at TUSK Partners. Have spent my entire career in the field of healthcare on the business side, starting in the business development world for DePuy Synthes, which is a subsidiary of Johnson & Johnson, doing medical device sales. Moved into ambulatory surgery center, doctor investor relations. So recruiting doctors to invest in surgery centers, and ultimately work with local hospital systems to develop some strategies. Went back to business school and began my management consulting career that started at ECG, moved into it at Align Technology, which is where I got introduced to the dental field, helping align with their strategy, specifically around DSOs. And along the way, met Kevin Cumbus and some other folks at TUSK. And that's how I ended up here at TUSK in 2020. And have had the opportunity to grow the M&A team here, and really excited about today.
Yeah, I'm glad you're here. Ryan spends every waking hour on the front line with our clients, with his team, and with the buyers. So for a conversation like this around the M&A markets, it just really wanted you here to share what you're hearing, because it's an ever-evolving, very quickly moving market. And we wanted the most current information from you and your team for the purposes of tonight's webinar. So thanks for making time.
Certainly.
Briefly about TUSK, the markets are always moving. There's a lot of activity out there. It's been a transformational year inside of our business. Today, we have 13 fully dedicated team members that collectively have over 50 years of experience across investment banking and private equity. The business itself covers 100% of all specialties in all states. We've got 40 years of dental industry experience and closed $750 million worth of transactions. What I'm really most proud of this year, Ryan, is the team. So we added 5 new team members over the last 12 months for a couple of reasons. One, we want to make sure that our customer continues to receive white glove service because when it comes to selling your life's work, you should have a team's approach to help you. And so we added a new team member on the analytics team, Taylor Adams, and the M&A side of the business. We added Josh Swearingen and Yazan Abusad, and then on business development, we added Alex Malone. And really, I think we have a team that has a wealth of experience and really the energy it takes to run these deals, run these processes, talk to the buyers at all times of the morning, all times of the evening, to actually get the outcomes that we know our clients deserve.
And quick shout out to marketing as well. We added Mariana. So in an effort to be able to put on webinars like this for all of you and continue to create content, blogs, and so on and so forth through social and through our website. We also added one individual on marketing.
Yeah, that's right. We wouldn't be here without her.
That's right.
Good. Well, we'll kind of jump into one final note on the business itself that I think is supremely unique about TUSK is all these logos you see on this slide are companies that our team has worked for in the past. And this really, I think, highlights a really important feature of TUSK. And that is that we have a wealth of knowledge and experience in finance, investment banking, private equity, and M&A work, but that is coupled with a depth of experience inside of dental DSO and healthcare that is unmatched by any other group that does what we do. And I think really enables us to lead with compassion and experience when working with our clients. So shout out to the team. Thanks for all you do. And without further ado, we'll go ahead and get into the content here. Mr. Mingus, I'll hand it over to you.
Great. Thank you, Kevin. So 2022 started out pretty interesting. 2021 was Q4 of 2021 was maybe the busiest quarter in TUSK's history and M&A's, probably the entire M&A markets, and specifically in dental, talking to a lot of our industry colleagues around what happened at the end of 2021 and ultimately the hangover that we kind of felt in Q1 of 2022. We came out of it pretty light, and we went out and just made a few phone calls to industry colleagues, attorneys, QV firms, et cetera, and everybody kind of had the same sentiment. Lucky for us and lucky for the industry, it picked up rather quickly towards the end of Q1, and Q2, Q3, Q4 were all very active for us in 2022 in our market, which, quite frankly, given everything that was happening outside of dental and private equity, we're really lucky. As everybody knows, the public markets were in free fall starting in 2022. The Fed went through 7 rate hikes, and we're looking at potentially one more coming here in early 2023. Crypto markets
crashed
completely under. Yeah. And all of you on this call and us all faced inflationary pressures, both within your business, at your home, at the gas pump, et cetera. And it was a pretty tough year all in all, but outside of our industry, but we feel really good about the year that was in 2022 and the momentum that it's carrying into 2023.
Yeah, the only thing I'll add is, reflecting, kind of juxtaposing Q4 and mainly December of 2021 to, let's call it, December of 2022. There was so much pressure to get those deals done in 2021 out of fears that there was going to be a material increase in the taxes paid related to transactions like this, right? I mean, Biden was threatening a 37% long-term capital gains rate, which would have increased the long-term capital gains rate by 100%. This year, December of 2022, we didn't have those same fears and those same concerns. So although I would say we had a really, really good December, we had some deals trickle over into January, which are nice to be closing right now. But because we didn't have that major event coming, I would say it was a more relaxed holiday. I was able to see my family. I think you were too.
Yeah.
So it was kind of a nice change of pace compared to 2021. And I don't think about politics just for a quick minute. It feels like the House is settled finally. We got through the elections, and it feels a little bit like we have a lame duck in office at this point. It was going to be really, really hard to get things through the House. Yeah, the Senate's owned by the Democrats. But I think it's going to really, really be hard, which bodes well for business owners.
Sure.
Because it's the uncertainty that drives fear in the markets. I don't know why the markets are not recovering, but hopefully we've got enough of a solid footing in the political realm now to see the markets begin to recover. So I'm optimistic on the political sphere.
Certainly, well said. So year in review for TUSK, we closed deals across 12 states in 2020. We actually closed deals with 10 unique buyers. A couple of those buyers we dealt with more than once, but there were 10 unique buyers. We actually had 62% of our total enterprise value in aggregate. If you were to look at how much of that came from general dentistry versus how much came from specialty, 62% came from general dentistry and 37-ish, there's some rounding there, with specialty, which is quite a flip. Last year, we had this same slide, and it was 70% of total enterprise value in 2021 came from specialty and 30% came from general dentistry. So there's certainly a story to be told there around why general dentistry was more active in 2022. And it really stems around their recovery was a bit slower than that of specialty.
Yep.
Oral surgery, things like that recovered much faster, orthodontics than general dentistry did. Coming out of COVID, I think hygiene had a lot to do with that. Hygienists were hard to come by.
Yep.
Harder to get some of the assistants back to work. And there were certainly some inflationary pressures and probably a lot of job hopping that was taking place in 2021 that was ultimately shaking up those deals, and our clients that were general dentistry, some of them paused in an effort to take their deal to market in 2022 to get rid of some of that TTM period that was more volatile.
Yeah, I mean, to this point, back when we were doing COVID adjusted EBITDA, the adjustments that we were making in the specialty practices were much smaller than any of the adjustments we were making on the GP side. I think a lot of that had to do, especially in oral surgery and endodontics in particular, is that they were still seeing patients, right? If you're in pain and you need to go to a dentist, well, if you got a root canal that needs to get done, you're gonna get seen.
Sure.
So those businesses did remarkably well because they were probably picking up patients from GP offices that were closed.
Yep.
And they continued to do exceedingly well. Then you also had the whole cosmetic revival. So you had adult ortho really picking up. So orthodontics was doing great. I'm happy to see the GP businesses return to, let's call it 2019 levels.
Yes.
We did not want anyone to sell below that level because so rooting for the rising tide lifts all boats. But it's interesting to see how that shock to the system due to COVID manifests itself in the M&A markets.
Right. Multiples for 2022 were largely similar to what we were seeing in 2021. A little bit of an uptick in the solo deals for our deals, in particular. Again, these are averages, so some are below this, some are above that. Exit multiples for our group practices largely in line with what we were seeing last year. Again, some opportunities that we had traded in double digits and others a little bit below. There are a lot of different dynamics that go into what multiple gets applied to any particular business or asset. So not a whole lot of change here given these are averages. Two newly formed DSOs. So last year our clients were 3 unique businesses that formed new dental platforms, meaning they were of such size and scale that they warranted an entirely new DSO to be formed upon. This year, we had 2 clients that were part of 2 different clusters of businesses that created 2 new DSOs. So for those of you that don't know how a new DSO formed, effectively you need no less than $3 million of EBITDA in order to gain the momentum necessary or the critical mass necessary to gain an investment directly from a private equity group to form a new DSO. Neither one of our clients were true platforms and above 3 million on their own, but collectively they made up that of a cluster that created a new DSO. So that's always really interesting. There are a lot of headaches whenever dealing with a group that's forming for the first time, depending on who they are using for legal, matters tremendously as to the speed at which they're able to close their deal. Both of these deals took a whole lot longer to close than, if they had partnered with a strategic, and a whole lot longer to close if they had been an individual platform of themselves, because they're working that buyers depending on 5 deals to all get closed at the same time, and legal to get done, and Q of E's to come back the right way, et cetera, et cetera. So anyone out there that's thinking about partnering with a newly formed DSO, there are a lot of headwinds there, and there are a lot of questions that you'd want to ask of that situation in order to make sure that you're able to actually get to the finish line, because we're putting it on our backs a lot of times, and or the attorneys that are representing our clients are teaching the buyer what documents need to look like. So
Yeah,
really,
we see this time and time again. I mean, I know Alex, who runs our analytics department, will sometimes have to get on the phone with buyers and say, hey, your quality of earnings firm does not know what they're doing. They're asking questions heading down the wrong path. And thankfully, we're able to provide that feedback. There's a deal right now that we're working on that's got a new law firm attached to it, and they can't get out of their own way on the buy side. And our clients' counsel is having to educate them about the corporate practice of dentistry by state, like stuff that we've been talking about for 7 years. And I get it. The firm just isn't steeped in this knowledge yet.
right.
But it ends up costing our client money and time. And that's troubling.
Yeah. Time kills all deals.
Ron, one question about newly formed DSOs. We hear a lot of folks say, hey, I want to get on the ground floor. I want ground floor equity. I want my shares priced at $1. So I get to ride it all the way to the top. And all the DSOs that talk about, and private equity groups talk about their returns, talk about it as a return on invested capital. But it's that multiple 2, 3, 4 times cash on cash return that they're talking about that starts with the equity at the ground floor. So when folks have or if they're entertaining an offer that's a brand new business, good, bad, should they feel good about that? Is ground floor equity just in and of itself a great thing?
Well, certainly not in and of itself. It's a great thing. These businesses need to quadruple in size in order to produce a 4x return on your equity. So who you're partnering with, what is their growth strategy once they acquire you is critically important, which we'll actually talk about a little bit later. But ground floor equity in and of itself is quite risky and quite dangerous if you don't know what questions to be asking and where to go outside of just that individual buyer to seek information that will help you make an informed decision around the group that you're considering partnering with.
Yeah, it makes sense, right? Because if it's going to get me the highest returns, it certainly comes with the most risk.
Of course.
Right.
Yeah.
Okay, that's helpful.
So this is really an opportunity to showcase some select transactions that we had the great opportunity to work with, celebrating our clients, the buyers that were on the other side. It was a great year, reflecting on building some of these tombstones. As you can see, there are a couple buyers that we worked with multiple times. Again, this is just a select number of the transactions from 2022, but it's really an effort to also illustrate to everybody on this call how broadly we go for our clients. We have a large deal team for that reason. Kevin mentioned the white glove service. Our job is to bring the entire spectrum of the marketplace to our clients. They might be an oral surgery group that only want to partner with an oral surgery only group, but we encourage them, if not force feed them meetings with multi-specialty groups or even a GP-centric group where they're the centerpiece of and could benefit for a multitude of reasons. A lot of our clients came to us with something in mind and ultimately ended up doing a transaction with a very different buyer than they had initially thought that they would be entertaining. We always tell our clients, if we've done our job at the end of the day, that you'll have the luxury of a difficult decision because you're going to like different cultures. You're going to like various deal terms and structures. You're going to, have more confidence in the equity in one group versus another. There's more upside in one group versus another. There's less risk with one group versus another. There 17 different deal points that we're walking through each LOI with our clients to make sure that they understand the weight of the relative qualitative and quantitative deal points that exist. And, kind of just toggling back and forth between all of these, there's a wide range of buyer types, and there's really just no simple rhyme or reason when somebody comes to me and they say, well, who would be a good buyer for me, or who would be a good partner for me? And we always deflect that question, or excuse me, that answer to, well, let the process play out and you'll be incredibly pleasantly surprised and have a whole lot more confidence in whatever decision you end up making.
Yeah, well, we just went through our annual review with our EOS consultant. We were reviewing our VTO and looking at, what's important in our business, what's our guiding light, what's our true north. And, one thing that we revisited is kind of what are the outcomes for the client? And it's the right partner at the right price, right? So, and what the partnership matters so much, and it's ultimately it's never our decision, right? So whatever our client wants to do after we've negotiated the offers and wrung every penny we can out of the buyer, then they get to make a decision about partnership.
Right.
And there's every year, and looking back, there's always a handful that don't choose the highest enterprise value. And that actually makes me really, really happy, because what that means is they chose the right partner for them, and that dollars alone were not the driving force in the decision making.
Right.
So another great year. Great to see some of these transactions from 2022 highlighted.
Yeah. So lesson learned in 2022, certainly across the year, continued to see more buyers enter the space. We referenced the two newly formed DSOs that our clients partnered with. Took calls all year long and are continually taking calls as recently as this week with private equity groups, family offices that are interested in making an investment in the dental space. So, I'm certain by the end of this year, this number will tick up, but, I'm acutely aware of a handful of newly formed DSOs over 2022, and I'm sure that there were a multitude of others that I am not even aware of. But really exciting to see new groups enter the space, and even some groups that have completed a dental exit and are entering the space for a second or third time. Mm-hmm. Think of Thurston and some of these other groups out there, Shore Capital, that are on their second, third, fourth dental investment. Pretty exciting stuff.
It's interesting. We keep hearing at these conferences that there's going to be more consolidation at the top of the market, where, for example, Heartland, they partnered with American Dental Partners during the pandemic. I think that folks believe you're going to see more and more of that, especially for the biggest DSOs that have a lot more work to do to grow by 50%. They're going to have to start gobbling up some of these, let's call it, 50 to 100 location groups in order to keep pace with investor needs and demands. But we're not seeing that happen at a rapid enough click to keep growth flat, right? So there's some that are consolidating up top, and there are new ones being created all the time in the doctor-founded, debt-funded space, and some of those are becoming new platforms.
Right.
And it does make me wonder, when are we going to see some consolidation at the top of the market? It doesn't feel like there's appetite to do that right now. Right. So it should be a net gain for at least another 12 months.
Right. So even in a market with lots of practices and groups for sale, our clients commanded extremely high valuations. So the takeaway is, who has a hot hand matters. It's right place, right time. Every DSO is putting together a different puzzle, and our client is a different puzzle piece at any given time for each one of those DSOs that are entertaining the offer. So, it might not be a historically high bidding DSO, a DSO that places high multiples on a deal, but for the right business at the right time, they're willing to stretch. So that's again why going very broadly for our clients ultimately yields the greatest outcome.
Yeah, we've seen some buyers, say, we were interested in that deal in that market historically, or maybe last quarter, but at this point, we're not interested in that geography at this moment in time.
Yeah.
So we've taken a couple of deals to market, and it was called the Greater New York area. And some of the buyers get hot and cold. They're like, I've got too much concentration. I've got some operational work I need to do in the businesses I've acquired. I don't have the team to integrate another $5 million worth of EBITDA. So I'm going to sit this one out for the good of the business. I mean, we've heard all those things.
Yes.
So that's really one of the reasons I love this space the most, is because even the buyers are ever evolving and ever changing.
Yeah, they're not in the same place. Every 3 months things change. We're regularly asking folks for updated target acquisition profiles, and we never make assumptions that their target acquisition profile is the same. Anytime we take a deal to market, we just go to everybody and do the work.
Yeah. One other thing about the hot hand, we've seen this really come into sharp focus this year, is cost of capital. Sure. And those with more affordable capital or access to more affordable capital are certainly in a position from a balance sheet perspective to pay more and not have to be as concerned about their debt service coverage ratios or covenants with their lenders, or have to put more equity into the deal to be competitive. So knowing the balance sheet of all these buyers has been really, really helpful as well in thinking about who can stretch and who has additional dry powder they can put toward a deal.
Right. So newly formed groups are moving faster than legacy groups. Once a train leaves the station and capital has been committed and a DSO has been formed, as mentioned earlier, their job is to go out and quadruple whatever that initial EBITDA was. If they acquired $3 million of EBITDA to form that DSO, or $5 million of EBITDA to form that DSO, well, they've got to quadruple that thing in size or more in an effort to start producing meaningful returns to those limited partners that committed that capital. So the newly formed groups were more aggressive in 2022, and that just is always the case. There just happened to be more newly formed DSOs in 2021 that needed to continue to grow in 2022.
Great.
Tougher environment to maintain margins. So as mentioned before, inflation impacts supplies, increased salaries and wages, decreases EBITDA, cost of capital certainly is changing the dynamics of some of the deal structures that are existing and the valuations that we're seeing from some buyers.
Well, one thing on this, in every process we go through with the client, we establish an adjusted EBITDA before we go to market. And then we take that deal to market, and time ticks on, right? And then we get an executed letter of intent, and then there's a quality of earnings process. Mm-hmm. And, Alex and his team, Taylor, Sam, George, I mean, they're critical in this because there's a roll forward from where we were to where we are to get a current trailing 12-month EBITDA. So now think about doing this in an inflationary environment where salaries and wages in some cases have gone up 10, 15% across the board for some of our clients. And the buyers want to push back and say, look, the fundamentals of the business have changed. The costs have gone up. This is material. We need to make a change to purchase price. And what's been awesome this year is seeing the entire analytics team find additional wins and prepare the client in advance to know this is coming, to create additional revenue streams or cost-saving tools and to kind of go ahead and put in place to offset what we know is coming through a deterioration in profitability in an attempt to maintain the enterprise value that was put on the paper when the letter of intent was signed.
Yeah, these are living, breathing businesses, and we always tell our clients to run the business as if they're not going to transact.
Right.
Because if a deal, God forbid, does fall through, they've got to live in the business. And if they lost a key person because they weren't willing to commit to a raise in a timely manner, obviously we need to stay in the loop. And at some point sometimes we need to bring in the buyer as well and say, like, this is the situation that we're facing. Can we collaborate on a solution that everybody is comfortable with? Because acquirer, you're going to have to live in this business if this person is gone as well. So sometimes there are really meaningful conversations that come up with creative solutions for it.
Yep.
So 2023 M&A outlook, we're 19 days into 2023, and it is a very different Q1 this year than it was in 2022.
Yes.
I think we could have as many as 4 closings this month.
Yeah, we are certainly going to have the best Q1 in the history of the firm. And a lot of that is due to excellent marketing efforts and business development efforts. I think some of that has to do with the seasoning of the market and understanding the COVID impacts and seeing the businesses recover. But also we didn't have that fire drill in December of this past year to close all those deals. So because there wasn't something materially happening at the end of the calendar year, we didn't feel the pressure and didn't put the pressure on the attorneys, the QB firms to get deals done. Still ran with pace, still ran with a sense of urgency, but I think that the net result will just be a smoothing out of deal flow over the course of Q4, Q2, and Q1 and Q2.
Right. So we do have some tailwinds going into 2023. There were quite a few recapitalization events that occurred in 2022, which is always great for the industry.
Yes.
Always great to see these. So you've had specialty dental brands, DCA, Paradigm with BlackRock, which was quite interesting to see BlackRock and Blackstone for that matter, with their new investments into the dental space, with DECA. MB2 is 2021, but still, one of the very large DSOs out there to go through a recap, so certainly worth mentioning. And then you had US Oral Surgery Management. Just great to see for the industry. Great to have that wind in our sails as we continue to move on and this market continues to mature.
Yeah, just look at these headlines. It's 1, 2, 3, 4 specialty DSOs recap. And then you kind of got legacy DCA and MB2 as well that have specialty in them. But it really was a vote of confidence for the specialty aggregators when these multiples became known, like for what specialty dental brands traded for and what Paradigm and also US Oral Surgery, right? So these were extremely healthy multiples and continue to add fuel to the fire to the consolidation of these specialty services, specialty practices.
Yeah. So I want to cover some headwinds, both macro and dental industry specific headwinds that we're facing. I think this comes as no surprise to everybody, but looming recession. Some people say we've already had it. Some people say it's still coming. Some people say we're living in it. Depends on who you ask, but it's certainly a topic of conversation and consideration for all these buyers and the private equity groups that are backing them. Inflation, again, both in your office, at home, at the gas pump. It's really impacting EBITDA compression, et cetera. Interest rates, that's impacting the cost of capital to the private equity groups out there that do use debt to fund their deals, in addition to the dry powder equity that they've raised, and the credit markets. So these are certainly macro headwinds that we are facing and having to address. In the dental industry, we continue to see rapid consolidation, which is good. Not sure when that tipping point is going to be in terms of saturation. Is it 30? Are we at 30% today? Are we higher?
Yeah.
I don't exactly know where we are. Depends on who you ask, and ultimately on a state by state, it's very different. I think we've been told that the state of Arizona is the most highly consolidated state with respect to corporate dentistry, but not a whole lot of perfect data out there to know in terms of where we are as a country.
Yeah, so the data is terrible. But it does feel to me, Ryan, that we should begin looking at this by specialty if at all possible, or at least put specialty to the side and GP on the other side of the table.
Sure.
Because the aggregation of specialty practices has happened so quickly. And their business development teams are so good, and many of them are paying really nice multiples with what we've seen to be valuable equity roles.
Yeah.
So that there's a lot in the favor of that. And specialists are gaining an awareness of, hey, I too may want to be in DSO. Doctors who swore they would never, ever be a part of a business like that see the opportunity that their colleagues have taken on, the proceeds that they've enjoyed, the valuation of the equity is realized upon the first recap, and the fact that depending on the DSO, their life has not changed too much, right? There's no downward pressure clinically. Some of the administrative burdens have been lifted, and all of a sudden, doc's spending more time with the family and at the football games and at the piano recitals and all that stuff. So
right.
I think there's a lot of really nice, favorable characteristics, I should say, in the specialty space.
Yep. And more GP deals, we referenced it before in 2022, we saw the majority of our deals come from general dentistry practices.
Yeah, look, it was, again, I think we've spoken to this already, but GP was more slow to recover.
Right.
So we kind of had some pent up demand, I think, on the sell side for GP practices. And we've continued to see that in 2023. If you had to guess, Ryan, today, of all the deal flow you have in pipeline, where do you think our numbers will shake out as a percentage between specialty and GP on total enterprise value for 2023?
It's a great question. I would certainly say it's going to be closer to what we saw in 2022 versus what we saw in 2021. So I think we will have the majority of our deals generate from total enterprise value come from general dentistry deals. Got it.
So a little more normalization this year.
Yeah.
Got it.
I mean, it does make sense. There's more GPs out there. So I mean, that certainly makes sense. Deal structures are changing for some buyers out there, not all, but there are some buyers out there that their cost of capital has increased. And as a result, they can't put as much cash at close into the deals as they have historically, and are requiring larger equity roles for our clients. Now, some of our clients love the concept of equity, and are it's not impacting their decision making, but there are other clients that absolutely wanted to maximize their cash at close for a number of reasons, fully funding their retirement, debt service, you name it. There are a multitude of reasons why somebody might need more cash than equity, but certainly are seeing some buyers put more equity into their deal structures than historic.
I remember a call we had with a director of business development for a large DSO, and he said, look, the guidance we're getting from our private equity firm is, although we even have a pretty affordable debt facility, we need to treat those dollars like gold, because they are so hard to come by at these terms that we got to be really careful with them and use them judiciously.
Yes.
And as a result, we are changing our structure. Where we used to be 80-20, we're going to now start the conversation at 7:30. Oh, by the way, we're pretty rigid on that.
Yes.
And they're not the only one. Now, everybody does it differently, but it is the first time we've seen let's call it a more broad sweeping reallocation of enterprise value with more leaning towards equity than ever before.
Right. So there are some headwinds, some struggling DSOs. So in addition to those tailwinds of all of those recapitalization events, there's certainly a couple large DSOs out there that have historically been active in our buyer pool that are not right now. And they have been advised that due to their current state of their business, they're not going to be an active buyer for the foreseeable future. And we'll continue to check in with them, monthly, et cetera, to see when they're ready to get back in the game. But it is certainly something to be cognizant of.
Yeah, we had one big DSO tell us mid-process that they need to go pencils down, and that they couldn't continue to place bids because the private equity company they're working with just didn't have the appetite for what they perceived the risk to be these days. Whereas other private equity groups are like, look, dentistry's recession proof, it's pandemic proof. We're good with the risk as long as the price is right.
Correct.
But that group is pencils down. I don't know what that business development team is going to be doing, but maybe looking for jobs the next couple of months, because they have to do deals to where hit their bonuses. Another thing that we saw this year was, we saw one big DSO go through some major balance sheet issues that took them out of the conversation on the buy side for a long time. They're still out of the conversation today, and saw a management restructuring as well.
Yes.
So these things are going to happen, especially when you have 150 private equity backed groups with 150 different philosophies around risk and price and all that comes along with that. So it's not gloom and doom. It's just the reality of any market this big.
Yeah, it's not unique to dental that there are some groups out there that are winners and there's some groups out there that are losers. The benefit to our clients, though, that when we do encounter a buyer that has to go pencils down mid-process, we've got a bench of buyers that our client could be quite happy with pivoting towards and can move quickly in an effort to still close their deal in a timely manner. So, whereas if somebody out there was exploring an opportunity with one of these DSOs and they were only entertaining that one buyer, and that buyer goes pencils down midstream, well, they're starting all the way back at zero.
Right.
Whereas we can quickly pivot, push to get out of exclusivity. And if the buyer does the right thing, they'll let our client out of exclusivity from that LOI, and we can go back to the number 2, number 3, number 4 potential buyer.
Yeah.
So 2023 forecast, what everybody's looking forward to. Some will be paying more and some will be paying less. I think that is not unique to any given year, but I think more so this year than ever because of the rapid changes in the credit markets, the rapid changes in access to capital.
On this, I'm thinking about some deals you've got in market right now. We got a text earlier this week about a deal that's sub $1 million of EBITDA that Josh, your colleague, took to market, and the multiple a buyer put on that thing, which was breathtaking to see. And then there's another, buyer out there that's really holding pretty firm to 2019, 2020 valuations and higher. They're winning a lot of transactions right now.
Yeah.
And I think on the paying less side, some buyers are just gone, a small handful, 2 or 3. And then the ones that are paying less, I want to make sure our listeners understand some of that can be interpreted as just less cash at close. Some of that can be interpreted as less total transaction value.
Correct. And the contributors are cost of capital, access to capital, where are they in a recap cycle? So if they're newly formed and they're on the ground floor, they're going to need to move fast.
Yeah.
Whereas if they're mid-cycle and maybe they'll say, well, we don't have access to cheap debt right now, so we're going to focus on organic growth. And anything we do entertain on the M&A front, we're just going to try to get for a steal. And it'll only be proprietary source deals. It won't be any brokered deals. And as such, their valuations during that time period are going to be lower than if they were further along in their recap cycle, trying to fatten the hog before it goes to slaughter, or if it just came out of the gate and was trying to gain momentum. So where they are might matter in terms of the offers that they're putting forth and how they're seeking growth in their business.
Yeah, look, these big groups engage their investment banking team 12 to 24 months before they are in market. And just like when someone engages us and we've got enough time to work with them, we want to borrow your words, fatten the hog before we take it to slaughter. And we have a good indication of where the deal is going to trade. Mm-hmm. And at the end of the road here, before they sell, they really are playing the arbitrage game. If their investment banking team has said, look, you're all day long at 15, could be as much as 17, anything they pick up for less than that is value additive. So long as it's not dilutive, it can be value additive. So that, end of cycle buyers are great ones too. But if you're their target, or if you're our client, just know that return on equity is going to be extremely low, or you might not even have the opportunity to liquidate any equity because you're so close to their recapitalization. So your equity is going to be hung up for however long it takes for them to trade, then however long it takes the second private equity group to finally get out.
Right. Less favorable deal structure, that Kevin kind of hit on that. It's, lower valuations could be interpreted a lot of different ways. Less cash at close, less total enterprise value, so on and so forth. But these are certainly the reasons for lower valuations. Alternatively, the reasons for higher valuations, the first few bullets look pretty similar, right?
Yep.
So cost of capital, access to capital, where they are in a recap cycle. So if they had a very favorable debt facility, and they don't need to treat those dollars like gold, as the example that you mentioned before, their deal structures don't necessarily have to change from what they've done historically. And again, where they are in the recap cycle, if this is a newly formed group and you're one of the first acquisitions after the inaugural platform, you might get to be the beneficiary of close to ground floor level equity, and somebody willing to pay a higher multiple because they know they have 4 years to dollar cost average down what they paid for your business through organic growth post close. And to the other reference around, if they're close to a recap, the ability for them to participate in the arbitrage and focus on that. The fourth bullet is perfect fit. I use the reference. Every DSO is building a puzzle, and every one of our clients is a different puzzle piece at any given time. So if you are that perfect fit for that buyer at that point in time, there's an opportunity for somebody to overpay, and you don't ever know who that person is unless you fully explore the market.
Yeah. I mean, that's where it played out really nicely for our clients over time. When we know the buyers, we know exactly what they're looking for, and we've got someone that we've spoken with over the years, or someone that's actively engaged us, that really is that perfect fit, that they believe they cannot, operate in that state or that geography without. And then, getting emotionally attached to a deal is dangerous because it ends up putting more money in our clients' pockets.
Sure. Sitting on dry powder, that's again just having a treasure chest of equity or capital that they can put to use to get deals done. Some of these groups are sitting on that. It's usually the newly formed groups that have all of those resources in place. And premium businesses will always fetch premium valuations. That's just the nature of it. If you've built an incredibly strong business that's well diversified in a geography that is attractive in the macroeconomics of that state are favorable from a political and just they're a growing state versus a declining state, premium businesses will always fetch premium valuations.
Sure.
So
great. So I wanted to talk a little bit, but people are always asking us, what does the future look like? Can you dust off your crystal ball and give me a look into where we're going to be in the future? And it's hard, right? I mean, we have touched on macro and microeconomic impacts to valuation. And being a numbers guy, sometimes for me, it's just easier to lay it out in Excel and teach it to you all. And so we wanted to walk through one example of what is certainly happening in the market with respect to margin compression. So in this example, we're going to look at a business that has revenue in full year 2023 of $5 million, 20% EBITDA margin, which gives them $1 million of EBITDA. And if this business traded at 8 times, that's all simple math we can do at home without breaking out our calculators. It'd be an $8 million trade. Well, let's talk about increased costs for a minute. Wages have gone up in most businesses. They've certainly gone up in healthcare businesses and very likely in the business that you own and operate. Supply costs are going up. Patterson, Henry Schein, Benco, those guys are just passing those increased costs on to the customer. And lab costs have gone up as well. I mean, they're facing the same thing you are with increased salaries and wages, and they're passing those costs on to you. The challenge with dentistry is you don't have anybody to pass those costs on to so readily because many of you are in in network with insurance companies, with PPOs. And they're not really happy to raise fees, right? They got their profit margins. They're not looking to reimburse you more. So the revenue line is a lot harder to move in the business of dentistry. So in the second column, we're going to look at the end of 2024. Potentially there have been 100. So same $5 million of revenue that didn't go up. The EBITDA before cost increases is $1 million. We had $100,000 of cost increases that net us $900,000 of EBITDA. Now, if the multiple stays the same, you're looking at almost $800,000 deterioration in value. So you saw margin go down by 200 basis points or 2 percentage points, and it resulted in an $800,000 of value that was lost. Now, this is bad. Now we're able to work through a lot of this, and we're help our clients window dress their business in preparation for a sale to maximize the value.
Yes.
But on a standalone basis, if you're out there doing this on your own, this is what you're going to be up against.
Right.
Now this is keeping multiples the same. If multiples move as well, it can get nasty.
Sure.
So same example, that 2023 column is exactly the same. The 2024 column has the increased costs in addition to a drop in one turn of multiple. So, going from $1 million at 8 times to $900,000 at 7 times, it's a net loss to this business owner of $1.7 million. And look, I'm not saying we're going here, but I think it's important for everyone on the webinar to know where this could go. I'm not seeing this year, but if the headwinds continue and the talking heads in DC and on the financial press continue to play the gloom and doom game, and the private equity guys keep listening to them, we could be heading towards a scenario like this.
Yeah. Now, lucky for us, a lot of our clients, are actively growing their businesses, and for the increased expenses, yes, but they formed a new de novo that's coming out of the ground that's contributing nicely, continues to contribute nicely, or they've added new associates. We're advising our clients all along the way on what can you be doing from the time that we bring you on as a client to the time that we get you to close. That's going to give you the least amount of heartburn possible.
Yep.
So, there are certainly a lot of ways that you can be offsetting these, and we'll take a look at your individual business and give you those pointers, so that along the way, if you do experience some headwinds with respect to inflationary pressures, you've got other mechanisms that can help offset it.
Yeah, well said.
The big picture, dentistry has been proven to be recession resistant. I think if we look back 2 years from now and the economists say that we were in fact in a recession from the middle of 2022 to Q1 of 2023, and I think that looking at the TTM periods that we're looking at today, dentistry is recession resistant in this case as well. It had proven to be pandemic resistant, which is great. So that's why we continue to get phone calls from folks outside of the industry that want to make meaningful investments in the dental industry. So, that's certainly a feather in our cap, and one that we get to wear proudly. Capital craves safe havens. Again, it's why we're continually getting folks calling us wanting to make that initial investment into the space. And why some of these private equity groups that are going through a recap ultimately decide to maybe not sell 100% of their business. They want to keep a meaningful stake in the business on a go-forward basis, where historically most of these private equity groups want to fully remove themselves from that business and go on to their next venture and produce a return to all of their limited partners. But seeing some of these private equity groups not go through a full recap is kind of interesting to think about what that means. I think it's a good signal that they want to continue to have money parked in this industry.
Yeah, they believe that there's more runway left in the business. Right. I'm sure as they are thinking about the preparation for go to market and working with their M&A advisors, that's a good signal to buyers as well, right? Hey, we certainly need to monetize some of this equity, get our LPs back their money, but the GPs and maybe some of the LPs want to stick in because we know that we believe that there's great returns in the years to come. And we think you, new private equity investor, are the right person we want to entrust you with our investment with.
Yep.
Just one other thing on private equity, there's still loads of money sitting on the sidelines, loads of it.
Oh yeah.
And the private equity, you look at the returns in the U.S. equities market, nobody can time the market, but as we're thinking about high net worth individuals thinking about savings and getting return on their money, they're putting their money with private equity companies. Family funds are continuing to invest inside of this industry. So the demand side of the equation just keeps getting bigger.
Yep. And shout out to everybody on this call, but you all are in building incredibly valuable businesses. We understand how difficult of a job you have. Kevin owned small, DSO and dealt with all the headwinds that come along with that. We live it and breathe it with our clients every day, and your work is hard, but you are rewarded by the market because they understand how hard it is and how not every single dental practice or small group is producing a 20% EBITDA margin. So for those of you that are out there doing that and striving to obtain that, you will be rewarded handsomely when it's time to go to market.
Yeah. Well said.
So when you're ready to exit, certainly let TUSK help you exit at the top. We had discussed about how broadly we go to our clients and the large number of buyers that we dealt with in 2022, and certainly look forward to working with each and every one of you in 2023 or whenever you're ready. What can I do? Those of you on the call asking yourself that, you can certainly contact us for a complimentary evaluation of your group or your practice. We'll analyze your business. We'll give you a free valuation range of your practice. We'll actually even model out what does a deal structure look like in DSO type A, dot on the spectrum, and then DSO type B, dot on the spectrum. What does it look like in terms of what are the levers, what are the dials that exist within the deals, and what does that ultimately equate to in terms of cash flow on an annual basis over a 5-year period, so you can understand what each one of them could ultimately yield you and your family over that point in time. And talk about risk, talk about cash flow, talk about returns, and there are a lot of different things that we can do through that exercise to help you get a better understanding about the range of opportunity that exists for you. We certainly have a lot of folks that we go through this exercise with, and we can identify areas of improvement to help them window dress them, for a sale, whether that's a couple months away or even sometimes further away. Some homework that they can take and in an effort to maximize the value of their business when it comes time to close.
Yeah, I love doing these exercises with clients so they know not just where they are today, but what they need to do in the future to maintain and grow the valuation on a go-forward basis. It's so much more than just, here's the number.
Right. Well, I want to thank everybody for attending this evening. Couldn't be happier about where we sit as in the market in 2023. Wish all of you the best for the year to come, and look forward to hearing from you.
Great, Ron. Thanks so much. This has been awesome. Great year in 2022, and sounds like you're out of the gate swinging in 2023. Thanks to everybody who joined us. For those of you who did put questions in the chat, we will be back in touch over the next 24 hours. Someone from TUSK will reach out to you, and be on the lookout for our next webinar announcement. Should be here soon. For those of you that make conferences, we will be busy. We'll be on the road a lot this year, and look forward to sitting down, enjoying a coffee, a breakfast, a beer with you out there on the road. Thanks, everybody. You'll have a wonderful evening.
Take care.